got our 8th consecutive year of double-digit dividend growth, so we've announced an increase in the dividend of 12% year on year, up to 9.8 pence for the full year. That's on the back of continued EPS growth. This is our 10th consecutive year of earnings per share growth, up to just under 30p. So in terms of dividend cover, we've got 3.3 times cover, so it's more than comfortable for us. Anything north of 2 times is fine. On all the key metrics, we're ahead. So in terms of revenue, it's up 11% to just over 51 million. The quality of the revenue stream's growing as well. We've been on this transition from a fixed line to managed service provider. We've continued on that transition, so we're now 75% of the revenues coming from managed services, which is up from 70 in the previous year, so good progression. We've seen improvement at the margin level, gross margin that is, but we tend to focus more on the EBITDA level because the support costs for the IT are all down in the operating costs. So we've seen EBITDA growing by 11%, so we've seen the economies of scale drop through from the revenue side. But also, having done 3 acquisitions in the year, one of the things we've always been focused on is maintaining our EBITDA margins, and we've done that again. So 21% last year and continued at 21% for the current year. So on all those key metrics down the P&L, it's a good, strong performance. So one of the key things for us is not only generating that EBITDA number, but it's also turning that into real physical cash. We are a cash machine, so we're generating 80 to 100% free cash flow, and then for us it's a question of what do we do with that? Do we return it to shareholders through dividends, which we have typically been doing, returning about 1/3 of the money to shareholders through the dividends, and then retaining the rest and investing it into the business, either through small amounts of CapEx, around 1% of revenue invested in CapEx, but the rest being reinvested back into acquisitions and growth through acquisition. We did 2 acquisitions during this financial year. So we had the acquisition of Shift F7 in August 2018, and then subsequently acquisition of a unified comms business called ETS Communications in November 2018. And then post-year end, we've also been busy. We've had the acquisition of Advanced Computer Systems in April 2019. It's looking to be a continuing busy year. Having just done the acquisition of Advanced Computer Systems in April, we're busy integrating that in with our Orpington education business to make a combined business, to get the economies of scale out of that business. We'll continue to focus on the quality of the revenue stream. We are 79% recurring revenue, so we'll continue to focus on that recurring revenue stream to give us good revenue visibility. Post the acquisitions that we've done, we're already at the 60 million revenue run rate, so we'll continue to try and grow that organically, but also build through acquisition on top.